Morning, everybody. Okay, the numbers. We had our chat on Monday morning. We were talking about the sort of divergence, really, between the US and Eurozone economies. We've had data out that really reinforces a lot of what I was saying then. Okay, Harry, yeah. Okay, no problem. So really, I'm just going to quickly show you as an example of the sort of data that we've had out this week. Of course, Tuesday was a pretty momentous day in terms of the risk rally coming to an end. And I'm just going to show you some charts in a second just to demonstrate that. But before I do, I'm just going to show you the data that's come out and how that sort of sentiment's built up, that the US is doing better than the Eurozone. We've got some classic examples here, actually. First of all, in the US, we've had that ISM non-manufacturing. This is the Institute of Supply Management. Obviously, we've got two sections of the economy, the main ones being manufacturing and non-manufacturing or services. We call it the services PMI over in the UK. They call it non-manufacturing in the States. 57, let's just get a highlighter tool. Let's be really neat here. 57, better than expected. Factory orders, although down, this one here, also came out at 3 o'clock on Monday, also better than expected, down 1% instead of down 1.3%, following a very good number in January of plus 1.4%, so better than expected. Tuesday, we had the revised GDP. Where is that little baby? Yeah, revised GDP. So there we go, still down 0.3%, the first sort of quarter negative growth. We have a second one then. Technically, the Eurozone is in recession. Let's take this highlighter tool off and get back to my normal cursor. And we can just pan up a little bit. Wednesday, a lot of data came out on Wednesday. Now, where was it? German orders. I remember seeing that. That was a pretty poor number. Here we go. German factory orders, down 2.7%. This is the engine driver in Europe, up 0.6%. Oh, sorry, we were looking for a figure of up 0.6%, following a pretty strong January of 1.6%, down 2.7%. Not good at all. And the other bit of data that is also key, certainly in relation to what we're looking for tomorrow. Remember, we've got that non-farm payroll employment data. The ADP, this is this sort of independent pre-non-farm payroll. This came out at 1:15 on Wednesday. Quite positive, actually. 216,000 jobs as opposed to 204,000 expected. So that bodes well for Friday. And I think expectations have improved. So that actually is quite positive. What's the other bit of news? That's pretty much it. One other bit of news also that crept out late last night or later on in the evening is U.S. consumer credit. 17.8 billion as opposed to expecting 10 billion. It can be a little bit of a volatile number, but basically, just so it's important to understand consumer credit. If people are feeling confident about themselves, about their own position, they are more likely to borrow money to spend. And an increase of 17.8 billion, that is quite positive, and I think it underlines the improvement in consumer sentiment in the States. And that's one of the reasons why the market sort of rebounded yesterday. But anyway, before I go on to today's date, I'm just going to show you some charts because people have been asking me about this risk on, risk off sort of stuff. And I think I've showed you this before. I remember when Adrian was away. This collection of charts we're looking at here is sort of designed to show you the sort of correlation between all these different markets. We've got gold in the top left. We've got dollar euro in the middle, top middle, copper top right. And then we got the E-mini, that's the S&P 500, the largest stock index by market cap there. Finally, in the middle, we've got the US Treasuries. And then on the right-hand side, bottom right, is the FTSE. You can see basically what's been happening. The gold market cracked a few days ago. Dollar euro cracked a few days ago, as we know. For all those of you using the longer term charts, you can see that the euro really gave us a signal, around the sort of 133 area. We've been down some. this is a bit of a sort of a rebound for the time being, Dave, but the downtrend is certainly accelerated in a lot of these markets, underlining the risk-off sort of approach now. And it's funny how it sort of creeps up on you. I mean, when I look at the FTSE, I've been watching the FTSE quite closely. This is the FTSE chart. It's been a very, very, very slow move. And if I just move those last two bars out the way, this is what it was looking like on Monday. Very sort of flat market, really. Then eventually, crack. Down we go, touch the bottom of the envelope. I'm not sure that it's over yet, but I can see lower prices certainly coming down to sort of test the sort of 57.20 area. But you can see this happening in gold, as I say, in the stock in the E-mini in the States, and copper as well. A lot of these markets have cracked. Dollar, euro, that's been taking a while. I think there's a lot of manipulation that goes on in these markets, which you don't have to worry about for our intraday sort of day trading approach to trading the markets. But just looking at the sort of daily chart here, it looked like, the euro was held up right up until the LTRO, the long-term refinancing operation, went off. Now that's out the way. I think a lot of participants are now saying, well, what next? And really, had I not seen these sort of moves, if I'd been sort of in hibernation since the beginning of the year, I would have expected euro to have sort of tested the 118 level, not be back up at 134. But that just goes to show you that, there's the forces at work at central banks and governments, etc., trying to rescue the situation in Europe. It's quite a task they're having to undertake. Which brings me on to that next painful subject, and that is the Greek deal. Let's put up a browser so you can see the headlines. Greece inches closer to deal. They are inching closer, despite the headline in the Telegraph today. I know it's incredibly tedious, all of this. I think it will get done. It's experience, not fun. I don't know what that's gone on. This 206 billion restructuring will take place. They've already got 40% backing the deal at the moment. Just so you know, this is all to do with the types of bonds that are out there. What they're trying to achieve is 95% acceptance, and there are two types of bonds. There's what's called the Greek law bonds and the international law bonds. The Greeks can use something called collective action clauses, or CACs, to force the deal on bondholders. If you take all that into account, cut a long story short, without boring the pants off you, it basically means we're going to be close to 90%. All we need then is a few of the other international law bonds to accept the deal. Boom, all job done. What the hell does this all mean, Jerry? We've been talking about this for God knows how long. The fact is, it does affect the market in a big way. Hi, Jerry. When is the decision going to be made, do you think? Nicholas, we will hear the news later on today. The deadline is today. They don't actually have a time when they're going to announce it, but clearly, knowing the way these things work, I wouldn't be surprised if they extend it, Nicholas. I'm sorry to be so woolly in my response, but that is the way of this. We've had deadlines every ruddy day, but for various things. But they have to get this done. I believe it will happen. The FT believes it will happen. Inching closer. It is painful. One of the questions I like to ask is, what does this all mean going forward? I've heard that a lot of people refer to this Greek sort of bond restructuring as Greek fatigue syndrome. Basically, what's happening is, like me, like you, Nicholas, like others, Harry and Malcolm and Stuart and Alison and Ashby, people are just turned off by this. That's basically what's happening. People are turned off. It doesn't necessarily affect, they're not following the Greek situation. It's in the market. We all know about it. It's just painful. I think actually what it does mean, of course, though, is it really is, how is this going to affect the Eurozone going forward? And it does have an impact, because what's happened in Greece has put a lot of international investors off. And I think a lot of politicians, this 53% debt relief, when you include the haircut that the new bonds have in terms of interest rates, the actual or coupon, the actual cost to bondholders is near, they're roughly going to get 70% haircut on their bonds, not just the 53% in terms of the new bonds that they're getting. But the key thing is this actual relief that Greece has got is it going to entice other politicians? What about Portugal? What about Italy? What about Ireland? They've gone through all this pain. Why don't they just write a bit of debt off? A lot easier than paying it back. So I do think this is a big issue going forward, and I do know that the way that there's a word called seniority. It's basically that some bondholders, notably the bonds held by the ECB, have been dealt with differently to those held by everyone else. So it's basically creating a hierarchy in the bondholders. And I think it's just left a nasty taste in a lot of people's mouths, and it's certainly killed what we call the credit default swap market dead in its tracks. No one's going to use those ever again because effectively Greece is defaulting in most people's eyes, and anyone holding CDSs are not going to be able to reap any rewards from it. So it's a real pig's ear, but it's classic Europe sort of way they deal with things in a very sort of piecemeal fashion, and the resolution is wholly unsatisfactory, but it sort of achieves an aim, really. Certainly it's prevented Armageddon in the markets, that's for sure. Okay, other than that, that's really the Greek news is the main bit of news. Thank you very much for listening. Have a very good day today, day tomorrow, good weekend. It's warming up. It's nice to get out again, and I'll be with you on Monday. Thanks very much. Bye for now.